We spend so much time talking about what to buy, but really buying is the easy bit. It's selling where most people make mistakes. There are many reasons you may get tempted to sell an investment: price changes, headlines, or someone else's view. But really, there's only 3 core reasons you should. Before you sell an investment, your reason should fit into one of these 3 buckets. This is not about selling when the price is simply down or that you read that someone else doesn't like it. This is all about only selling when your original reason for buying no longer makes sense. The thesis is the reason you believe this was a good investment for your time horizon. But the belief that this thesis is broken needs to be more than simply just the share price being down. It needs to be more fundamental. We need to look a bit deeper into why that's potentially happening. It could be that the business model is clearly deteriorated. There could be less demand for a specific product. There could be increased competition or an increased amount of regulation, which has caused the prospects of that company, through various different measures, to not be as strong as they were when you first bought the investment. It might be that you've lost faith in the management. Maybe there's been some key personnel that have been let go or fired. Maybe there've been some questionable decisions, maybe some over-promising, some under-delivering. And because of that, you don't believe in the future going forward. Or maybe it's something fundamental with the balance sheet or the income statement for that company. It could be that the debt position is starting to get out of control and it's costing the company too much money. It could be that profitability has started to reduce. It could be that they're burning through too much cash that is not sustainable long term. Or maybe it's that profit margins have reduced because raw materials have increased in price. These are all clear reasons that your thesis why you bought a specific company are no longer valid. And that is absolutely fine reason to sell that investment. And this works for ETFs as well. It could be that the exposure is now significantly different to when you first bought the ETF, whether that's too concentrated or there's too much of a tilt towards a specific country or sector. Say, for example, you bought a regional investment like a European ETF, and the UK, for example, has started to outgrow the other countries. That's not necessarily a bad thing because you've got the performance, but it might be too overweight for what you're comfortable with, and also more than when you first bought it. It could be that you bought the S&P 500 because you wanted a diversified investment in the US, but over the last few years, we've seen the big tech stocks really outperform the rest of the index, and that's made it very concentrated, where the top 10 now makes up around 40% of the index. And while on its own, that doesn't necessarily make it a bad investment, it's now very concentrated and very different to why you bought that investment in the first place, which was because you want a diversified portfolio. ETFs can be incredibly competitive while also being very similar in nature. It could be that you've got a choice of many different ETFs in the same region or sector, and you've picked yours based on the ongoing charge. But then if a provider comes up with an alternative that's more competitive, say for example, they've reduced that ongoing charge, it's got a similar size fund, a similar tracking accuracy, well, then it might make sense to move to that investment simply because it's cheaper. The main takeaway here is that price is not the thesis, fundamentals and exposure are. And if the thesis is still intact, selling is probably not about the investment itself, and it should really fall under one of these next 2 reasons. One of the most popular and well-known investment splits is a 60-40 split, where you have 60% invested in equity and 40% invested in bonds. And at times where equity is doing well and it's outperforming bonds, that investment split is going to shift over time. And just like we've seen in the last few years where equity has been doing really well, it's been outperforming most bonds. And therefore you could end up with a split that's turned into 70-30. And while it's been very good for your portfolio, because it means you've been getting the superior returns from equity, you also have to be disciplined to bring that back to your original split. There's a reason why you chose that split in the first place. It's not because you want the most returns or the most potential for the highest returns. Otherwise, you would have been 100% equity. It's likely that you want part of your portfolio in bonds because you want to reduce your volatility. You also want some downside protection, so when equity isn't performing as well, you've still got some returns coming in from bonds which are a little bit more stable. So it's good from time to time to trim these positions to bring it back to your portfolio split. And it's up to you to decide how much and how often you do this. It could be that you set a percentage. So say you set that when equity gets to 70%, I'm going to trim those positions. It could be that you do it once a year, and regardless of what's happening in the market, you just bring it back to your portfolio splits. And of course, you may have to do it in the opposite direction as well. Say equity has now gone negative for a couple of years and they've now underperformed bonds. Your portfolio split could go to 50-50. Well, in that case, now you need to bring it back to 60-40. And actually, this is a really good time to buy equity when it's down. Bonds have been doing really well. So you would trim your bond position and buy more equity and bring it back to that 60-40. And this disciplined approach where you're not letting emotion take the decision, you're simply just basing on those percentages. When equity is doing really well, you're taking profit and bringing it back to your split. When equity is underperforming, you're buying low, you're getting at a good price. So not only does this keep your risk aligned with your original plan, but it also could be beneficial for your total return in the long run. It could be that you just want to simplify your portfolio. If you've been investing for a number of years, you could have built up numerous amount of holdings that cover different countries, sectors, regions. There could be a lot of overlap, whether that's in ETFs or specific companies. It could be that you're too concentrated in a specific area, whether that's specific country, regional, or sector. So you're not making a decision based on performance or a specific investment or company. You're simply doing it to reduce the number of holdings you've got, which makes it easier to manage, easier to maintain, and also easier to analyze. It doesn't have to be something wrong with the investment, but ask yourself, is it still serving the same purpose as when you bought it? And if it's not, it's a really easy case to get rid and simplify your portfolio. If you really want to simplify your investing, I have a free ETF cheat sheet that you can download. It breaks down the most popular ETFs in different regions and different sectors, makes it easy to compare. It's the top link in the description below. It could be that you're buying a house or planning to in the next couple of years, and therefore you want to reduce volatility in your portfolio. It could be that you're 100% equity and you want to take some of that risk off the table, either hold that in cash or money market funds or even some bonds. And therefore that requires a shift in your portfolio split. It could be that you've got children on the way and you want a little bit more stability or an increased cash buffer. It's likely that your costs will increase and therefore that changes what you need from your investments. It could be that you're getting closer to retirement age and you want to reduce volatility in your portfolio. And if you're planning on taking retirement straight away, then sequencing risk is a massive factor you need to take into account. This is the risk of a market crash soon after you start taking income from your retirement pot. And because you're drawing income from it, thereby combined with a market crash, your portfolio value never recovers and it potentially might not last you your full retirement. As you get older, you'll prioritize capital preservation over potential returns. You may also end up in a position where your income becomes less reliable or less stable. It could be that you're self-employed and your income's quite variable. It could be that you've just been made redundant or that you're at risk of being made redundant. And therefore you might want some more stability from your investments. And therefore you can't afford to ride out volatility in equity markets. And therefore, again, you want to reduce volatility, whether that's bonds, money markets, or even cash. So you could summarize that as raising cash for a specific spend. But just on a side tangent, there's a caveat there that this is not just any spend. Clearly, this needs to be on a big purchase like a house, wedding, children, not just any spontaneous spend. I fell into this trap in my early 20s where I'd be quite good at investing regularly. I'd build up to about 4,000 or 5,000 in my investment account. And then one of my mates would be like, oh, do you want to go on this lads trip for a week? And it'd be so tempting. And obviously I got the money there and I'd just spend it. And because when you're at those relatively small amounts in your investment account, even though you get in a good percentage, say over 10%, you don't really see the monetary gain in your account. So because you haven't seen the compound effect yet, it's easy just to sell that and start again. And because I did this a number of times, my account value took ages to grow because I was constantly dipping into it. And I didn't have that discipline or separate out what I was saving for long term and potentially what I could be saving for holidays or cars or any more spontaneous splurges that you might want to have. So if your reason for selling doesn't fit into one of these three buckets, it's usually just emotion. Now, of course, there's going to be some really niche scenario that won't fit into these buckets that's still valid. But for 99% of the time, this strategy works really well. And it's a really easy checklist to ask yourself. Is the thesis broken? Am I rebalancing or simplifying? Or has my life changed? If it's none of the above, then it usually belongs in the do nothing pile. And by having a specific framework to work through, it reduces your emotion and reduces those emotional decisions. That is one of the biggest reasons that most investors lose money or they underperform the market. And it could also lead you on to further questions about what is the actual reason you're selling? Is it a headline that you've read? Is it that the price has fallen or that someone else is selling? When you can drill down into exactly why you want to sell, then you can determine whether it's a good decision or not. Another thing you could add on to this framework is to write down your investment objective or policy and be really specific about what your time horizon is, what your objectives are, what you want to get from your investment portfolio. And thereby you've got a set of rules then. So then if some stuff does start to drift, you can then refer back to your investment thesis and decide whether it still fits into that. And by writing it down, it keeps you accountable and it makes it more real and it makes it a bit more professional as well. If you want to discuss this further, then join my Discord community using the top link down below and we can chat about this in more detail. If you want to get yourself set up for 2026, then watch this video here. Thanks for watching and I'll catch you in the next one.